Hey there, and welcome. Have you ever looked at a business, maybe even your own, and wondered what's really going on with the money? It's about so much more than just what's in the cash register. Today, we're going to pull back the curtain and learn how to read a business's financial story. Let's jump right in.
This is the big one, isn't it? It's the question every single business owner asks themselves. You see money coming in the door, you see bills going out, but at the end of the month, are you actually making money? It seems like it should be a simple yes or no, but, well, the real answer is often buried a little deeper.
So, to really get a handle on this, we're going to follow the story of someone just like us. Meet Jane. She just launched her dream cafe, and it's buzzing. But even with a line out the door, she's trying to answer that same question. Is all this hard work actually profitable? Jane's journey is going to be our roadmap.
All right, so first things first, we need to check the cafe's performance. And the best way to think about this is like a report card for the business. Did it pass or fail the profitability test this month? Let's find out.
Now, this report card has an official name. It's called the revenue statement. You might also hear it called an income statement or a P&L. Its job is super simple. It adds up all the money the business earned, that's your revenue, and subtracts all the money it spent, your expenses, over a set period of time, like a month.
So let's take a peek at Jane's first month. Look at that. She brought in $10,000 in sales from all those lattes and pastries. That's fantastic. Now, her expenses, things like coffee beans, rent for the shop, and paying her staff, came to $7,000. You do the math. 10 grand minus 7 grand leaves a net income or profit of $3,000.
And hey, a $3,000 profit in your first month, that feels amazing. But, and this is a really important but, is that the whole story? Does knowing the profit tell you everything you need to know about the health of the business? Not quite. To see the full picture, we need to dig a little deeper.
So let's switch gears from the report card, which covers a whole month, to something different. Think of this next tool as a financial snapshot, a single picture taken at a specific moment in time. It shows us the exact state of the business right now. This snapshot is called the balance sheet, and it has three main parts. First, it lists everything the business owns that has value, things like cash and equipment. We call those assets. Then it lists everything the business owes to other people, like loans or bills to suppliers. Those are liabilities. And whatever is left over, that's the owner's piece of the pie, their stake in the business. We call that equity. And here's the magic trick of the balance sheet. It always has to balance. Always. So on one side, Jane has her assets, that $3,000 in cash profit plus her $2,000 coffee machine. That's $5,000 in total. On the other side, she has a liability. She still owes a supplier $1,000, and her own equity is $4,000. And what do you know? That side also adds up to $5,000. It's perfectly balanced.
Yep, the seesaw is the perfect way to picture it. You've got assets on one end and liabilities plus equity on the other. If those two sides aren't equal, you know something's off in your numbers.
Okay, so we've got a profit. We've got a balance sheet. We must be done, right? Well, not so fast. Because often that first draft of the financials, it isn't the final, honest-to-goodness truth. We usually need to make a few tweaks to get it right. Here's a real-world example of why. Jane's looking at her numbers and suddenly remembers, wait a minute, I catered that big office party at the end of the month. She's already earned that money, but they haven't paid her invoice yet. That means the cash isn't in her bank account, so it's not showing up in her sales. Her profit is actually lower than it should be.
This is exactly why we have something called adjusting entries. Just think of them as little internal corrections to the books. Their whole purpose is to make sure revenues are recorded when they are earned, not necessarily when the cash comes in, and expenses are recorded when they happen. This method gives us the most accurate and true picture of the business.
Now, there are two main flavors of these adjustments. Sometimes cash moves first, like when you prepay your rent for the next month. That's called a deferral. But Jane's situation is the other kind, an accrual. She's earned the revenue, but the cash just hasn't shown up yet. The important thing is to record that catering job in the month she actually did the work.
And trust me, you cannot skip this step, because if you fail to make these adjustments, it doesn't just create one tiny error. It sets off a chain reaction that messes up multiple parts of your financial statements, giving you a totally warped view of your business.
You want to see the domino effect in action? Just look at this. Let's say Jane forgot to record $1,000 in wages her barista earned but hasn't been paid for yet. Boom. Suddenly, 5 different things are wrong. Her expenses are too low, which makes her profit look bigger than it really is. That artificially inflates her equity on the balance sheet.
And at the same time, her liabilities are too low because she's not showing a debt she owes. One tiny mistake creates a total mess.
So how in the world do you catch these kinds of things? The answer is a process called reconciliation. It's actually pretty simple. You're just carefully comparing your records against an outside source, like your official bank statement. You go line by line, find the differences, and figure out what corrections you need to make.
Okay, so Jane has found her missing invoice, made her adjustments, and now her financial statements are telling the true story. There's just one last thing to do before she can start the next month fresh. She needs to close the books.
Now that sounds kind of final and dramatic, doesn't it? But really, all it means is hitting the reset button. You have to zero out those report card accounts, like revenue and expenses, so that when the next month starts, you're measuring its performance from scratch.
And the process is just a final tally for the month. The true adjusted profit that Jane earned gets officially moved over into her equity on the balance sheet. This closes the chapter on this month's performance, adding that value permanently to her business's story and gets her ready to start fresh on day one of the next month.
And there you have it. Assets, liabilities, revenue, equity, adjustments. These aren't just confusing accounting terms. They're the actual words, the vocabulary you need to read and understand the financial story of any business out there.
So let's just quickly recap the big ideas. The revenue statement is your performance report card over time. The balance sheet is a snapshot of your health at one moment. Adjusting entries are absolutely essential to make sure your numbers are telling the true story. And most importantly, all of this isn't just for bookkeepers. These are the critical tools you need to make smart, confident decisions about your business.
Because at the end of the day, that's what this is all about. Your financial reports tell a detailed story of where your business has been and where it stands right now. So the real question is, now that you know how to read that story, what are you going to do to write the next chapter?